Hello and welcome to today's extensive weekend video, which will be fast yet contain a lot. It will be called non-farm payrolls and what these mean for various asset markets, and we will dive into US dollar, yields, equities, and various other aspects worth mentioning, such as macro data and what these mean for the real economy. I've been saying in the daily article that US dollar downswing and yields retreat are the most predictable parts, the clues that had been available to us before the figure hit the wires. Such is the view when euro-dollar is being examined after being once rejected at the logical resistance where you see it having closed. This is the lower border of that resistance zone, meaning there is a bit of a potential for the upswing to continue. However, is this a reasonable assumption to call for a marked reversal in the direction of euro, especially following the trade deal, which is exactly the reversal that had marked the steep side as befits the start of the rightmost fifth of this chart, and we are seeing a retracement of a bit more than half of that side. So would that be enough, close to enough? I'm dropping deliberately close because the dollar direction together with yields is what will be dictating the equity indices direction and relative performance as well. Here we go with 10-year to 2-year yields. Well, short-term yields have retreated quite a lot more than corresponds to the long-term ones. So considering that this is actually a steepening of the yield curve, what does this say about the economy as such and the prospects? Let's compare US 10-year yield, that is the black line, with German 10-year yield. And we can see that the leading Eurozone economies, that instrument had not been appreciating by nearly as much as the US counterpart. When it comes to Japan and the policy normalization, neither here we see a marked retreat when it comes to yields. So, if you look once again at the dollar chart, is this what had been powering all of a sudden this reversal in US dollar direction from, say, 97 rounded off to 100 relatively fast, and now we are seeing is this a retracement only? Right. That's the way I'm leaning, and the fact that selective country deals and basically a resolution of the tariff uncertainty when it comes to each major trading partner of one by one is being resolved. This provides greater clarity of the US dollar necessity and relative comparison of economic prospects in the period ahead compared to these major trading partners. This was the yields perspective at the moment when I called, or basically, yes, it could be said at the moment because this is being made during the European session comfortably before the non-farm payrolls announcement, when I had been calling for yields to retreat. And going until they did. And this is exactly the hourly chart continuation, how it proceeded during that day. Following an initial jump, there had been steady ascent, which had however not been translating to correspondent US dollar plunge, because the US dollar had depreciated only in the final 2 hours of the trading day. And at the very end, before the regular session's closing bell in equities, the US dollar had appreciated in the final 15 minutes versus the major currencies that form its non-trade weighted index, meaning Euro and Japanese yen. So much for the yields picture, that it was not the key driver that would be reflected mechanically throughout the trading session in US dollar performance. And here we go with the data and the underwhelming private payrolls versus expectations that have been the driving force behind the really weak headline undershoot. We had seen as well the participation rate a little bit ticking lower, and as well those here we go, that unemployment rate ticking a little bit higher, which are not the greatest sign when it comes to the job market. When it comes to the following data set, half an hour after the opening bell, manufacturing PMI had come in still recessionary. However, if you compare that versus the global manufacturing PMI final value, this has been more or less in line and quite pointing to the stabilization of the US economy in slightly contractionary values, because anything under 50 is contractionary, and this came in at 48. Manufacturing employment had been suffering as well, so there is obviously a lot of work to do on the reindustrialization front. On a positive note, those consumer expectations of inflation, for example here on the 5-year ahead, and there had been a further value that I cut off so that this table is better visible to you, that had been ticking lower, and that kind of corresponds with the oil downswing that we had seen Friday. Similarly to gold and silver surging higher, that had been of little surprise, considering that what a usual reaction to rising dollar and retreating yields brings. Of course, that's as well indicative of rate cut expectations being moved forward, and given where the Fed funds rate is, if you compare that to the 2-year one, the conclusion is quite clear. And lo and behold, the breakdown from the rising wedge happened. It happened finally on Friday, and there had been a few advance clues. But however, this had been a very easy breakdown in the way that stocks had the opportunity, and they did initially put up a good fight in keeping inside, trying to return back into the rising wedge on rate cutting hopes. However, as I had commented to clients, there had been an initial fly in the ointment that the interest rate sensitive place did not rally on rate cutting expectations. And similarly, if you remember those star earnings of late, of last 48 hours, these had not been resulting in such a strong market reaction that would justify prices remain bid up for more than 24 hours. The strength had been sold into, and I had been pointing patiently for a long time to the role of deteriorating financials, and I have been with clients talking as well another very important bellwether sector that is bound to notice the current shift in the market environment and forex markets. Such is the view of the sectoral performance on a daily basis, where you can see that it's pretty much a risk of picture. Even the real estate went down. And that is a typical example of an interest rate sensitive play. So much for the daily perspective, and on a 5-day basis we see the same, and you can see how far on a 5-day basis, on a weekly basis, financials have fallen, and they had been telegraphing where the risks are lying. However, as I said, there had been an initial window of opportunity where the S&P 500 index had been behaving constructively. However, that kind of reaction fizzled out relatively early within the first half of Friday's session.